Welcome back to Options Guide, the channel that teaches you strategies that actually work in real markets. I'm your host, and today we're talking about one of the most powerful and misunderstood tools in options trading, volatility. While others obsess over market direction, volatility traders bet on movement, not which way stocks move, but how much they move. Let's break down how this works and how you can start using volatility to your advantage. Volatility measures how much a stock fluctuates in price. Big swings equals high volatility. Small movements equals low volatility. Two types of volatility. Historical volatility, HV. What already happened. Implied volatility, IV. What the market thinks will happen, priced into options. Example, Apple's HV might be 25%, but before earnings, IV could spike to 45%. Options become expensive due to uncertainty. When to trade volatility. IV is greater than HV means options are expensive, so you sell volatility. IV is less than HV means options are cheap, so you buy volatility. Understanding the VIX. VIX less than 15. Low fear, complacent market. VIX 15 to 25. Normal range. VIX 25 to 35. Elevated volatility. VIX greater than 35. Panic mode. Pro tip. VIX tends to mean revert. Extreme highs often fall, and extreme lows often rise, creating trade setups. Strategy 1. Long straddle. Buy a call and a put at the same strike and expiration. Example, Tesla at $250. Buy 250 call equals $15. Buy 250 put equals $14. Total cost is $29, $2,900 per straddle. Break even. Profit if Tesla is greater than $279 or less than $221. Best when? Earnings season. Big news events. Fed, elections. Technical breakout setups. Low IV before expected big move. Strategy 2. Long strangle. Same idea but use out-of-the-money call and put because it's cheaper. Example, Netflix at $400. Buy 410 call equals $8. Buy 390 put equals $7. Total cost is $15, $1,500 per strangle. Pros. Lower cost. Higher potential return if the stock moves big. Risk tips. Don't risk more than 2 to 3% of your account per trade. Set profit targets. Aim for 100 to 200%. Exit quickly. Time decay hurts these trades fast. Consider legging out if the stock moves strongly one way. Strategy 1. Short straddle. Sell a call and a put at the same strike. You profit if the stock stays put. Example, Apple at $180. Sell 180 call equals $6. Sell 180 put equals $5. Total credit is $11, $1,100 collected. Profit zone, $169 to $191. Unlimited risk if Apple makes a big move. Strategy 2. Iron Condor, defined risk. Safer version of the short straddle. Example, Microsoft at $350. Sell 360 call. Buy 370 call. Sell 340 put. Buy 330 put. Net credit, $4, $400. Max loss, $6, $600. Profit zone, $340, $360. Best for sideways markets, high IV rank. Strategy 3. Calendar spreads. Sell short-term option. Buy longer-term option, same strike. Example, Google at $2,800. Sell 30-day 2,800 call, that's $45. Buy 60-day 2,800 call, that's $65. Net debit is $20, $2,000. Profits from time decay of short option. Stock staying near strike. IV contraction. VIX patterns. VIX greater than 30, sell volatility, IV likely to fall. VIX less than 15, buy volatility, IV likely to rise. VIX trading tools. VIX options, direct but complex, VXX, UVXY, long volatility, ETFs, SVXY, VXZ, short volatility, ETFs. Warning, long VIX ETFs decay due to contango, don't hold long-term. Volatility term structure. Contango equals normal market. ETFs lose value over time. Backwardation equals crisis mode. ETFs can spike. Correlation, VIX versus S&P 500 is about minus 0.7 to minus 0.8. As the market drops, VIX spikes, which gives you hedging opportunity. Volatility. Smile and skew. Put skew is higher IV on OTM puts due to crash protection demand. Call skew is rare, but can signal takeover or speculation. How to trade skew. Sell expensive options. Buy cheap options. Look for imbalances. Volatility risk management. Max risk per trade. 5% of account. Diversify. Mix long and short volatility. Time-bound. Know when you're exiting before entering. Pre-trade checklist. What's the VIX level and percentile? Is IV rank high or low on this stock? What's the term structure? Profit target, stop loss, portfolio fit. Avoid these mistakes. Selling volume when VX is low, risky. Buying volume when VX is very high, overpaying. Ignoring time decay, not having exit rules. Over-leveraging on single trades. Volatility trading opens the door to consistent profits in any market condition. Not by guessing direction, but by trading movement itself. Buy volatility when it's cheap and fear is low. Sell volatility when it's expensive and panic is high. Use defined risk setups like iron condors, straddles, and calendar spreads to stack the odds in your favor. Stay disciplined, stay informed, and track your results separately from your directional trades because volatility is a whole different game. If this masterclass helped clarify volatility trading, smash that like button and subscribe for more real-world strategies. Drop your questions below. Have you tried trading volatility? What's worked for you?